Everyone knows about blue-chip dividend stocks and bonds, but what if I told you there are hidden income gems in the market that many investors overlook? These investments can offer high, steady yields, often 5%, 6%, 7% or more, and can add unique benefits to your income portfolio. In today's video, we're going to shine a light on a few of these under-the-radar income sources: preferred stocks, baby bonds/notes, BDCs, and closed-end funds. Don't worry if some of those sound unfamiliar, that's the point. We'll explain what each is and why they might deserve a spot in your strategy. By diversifying into some of these, you could enjoy solid income with potentially less risk than chasing ultra-high-yield common stocks. 1. Preferred stocks. The best of stocks and bonds? Preferred shares are often described as hybrid securities. They're technically stocks, equity, but they behave a lot like bonds. When a company issues preferred stock, it's usually for a fixed dividend, often with no maturity date. Preferreds typically yield around 5 to 7% in today's environment, and their prices are less volatile than common stock. For example, an index of U.S. preferreds, like the iShares Preferred ETF, ticker PFF, yields roughly 6 to 7% currently. Preferred stock prices don't swing as wildly as common stocks. Many have a beta of around 0.5 or less, meaning they tend to move only half as much as the overall market. Why? Because preferreds are senior to common stock in the capital structure. In a company's hierarchy, preferred dividends get paid after bonds, but before any common stock dividends. That's why they're called preferred. If a company hits a rough patch, it must halt common dividends before it ever halts preferred dividends. This priority can make the income stream more reliable, though not guaranteed. Preferreds are like high-yield, fixed-income cousins of stocks. Many are issued by stable, dividend-paying companies, such as banks, insurance firms, utilities, and real estate investment trusts, REITs. These companies use preferreds as a way to raise capital without diluting common shareholders or taking on debt. For investors, buying a preferred is kind of like getting a bond-like income, fixed dividend rate, but with some equity characteristics. They trade on exchanges like stocks, and some can be perpetual with no set maturity. What are the risks or catches? The main two are interest rate risk and credit risk. Since most preferreds pay a fixed dividend, their prices move inversely with interest rates similar to bonds. When rates rise, new income investments come to market with higher yields, so existing preferred prices often fall to yield equivalent amounts. We saw this in 2022. As interest rates spiked, PFF, the preferred ETF, dropped because its portfolio of 5% yielding preferreds had to adjust to compete with newly issued 6% yielding ones. The flip side is, if rates fall or even stabilize, preferred prices can recover, and meanwhile you're clipping a nice coupon. The other risk is credit or financial health of issuers. Preferreds are usually issued by strong companies, but in a severe crisis, think 2008 for banks, some preferred dividends can be suspended. Usually they accumulate if cumulative preferreds, meaning the company has to pay the missed dividends later before any common dividends resume. It's rare but possible. So as an investor, one strategy is to diversify across many preferreds via an ETF or CEF, or stick to high-quality issuers. One great thing, tax treatment. Most preferred dividends are treated as qualified dividends from U.S. companies, so they get the lower tax rate like common stock dividends. That can make a 6% preferred yield even sweeter after tax compared to, say, bond interest, which is taxed as ordinary income. How to invest in preferreds? You can buy individual issues. They usually trade around $25 per share par value. E.g., you might see something like Bank of America 6.0% Series GG preferred, or use funds. Funds like PFF or PGX, ETFs, or closed-end funds like FFC, Flaherty and Crumrine Preferred Fund, provide instant diversification among dozens of preferreds. The funds handle the due diligence and trading. You just sit back and collect income, minus a small expense ratio. Preferreds truly are a hidden gem for many. They're not as popular as common stocks, but for income, they can be very attractive. Many retirees use them to get a bond-like yield with a bit more kick. They tend to be less volatile. Even in stock downturns, preferreds might only dip mildly if the issuers remain sound. 2. Baby bonds and exchange-traded debt. Small packages, big yield. Now let's talk about baby bonds. Despite the cute name, these are basically regular bonds, debt, issued in small denominations, usually $25 par, that trade on stock exchanges like a stock. Companies, especially financial firms, utilities, and some REITs, will issue these subordinated notes. For investors, they're accessible through your brokerage just by buying shares. They often carry fixed interest rates, and many have set maturity dates, unlike perpetual preferreds. Yields can be in the 5 to 7% range as well, depending on the issuer and maturity. Because they trade like stocks, they're easy to buy, sell, but they still have the underlying characteristics of a bond. Interest payments, maturity at par, typically. Why consider baby bonds? They can offer a steady interest payment, usually quarterly, and a bit more security than preferreds or stocks, because as debt they rank higher in the capital structure. For example, many utility companies have baby bonds that yield 5% plus. Some niche lenders or closed-end funds themselves issue baby bonds that yield even more, though higher yield often means higher risk issuer. These are somewhat hidden because they aren't as widely covered. You won't see them in the Dow Jones or S&P tickers, but income enthusiasts seek them out for stable payouts. They're subject to interest rate risk too. Their prices will move with rate changes and credit spreads. But if you hold to maturity, you know you'll get $25 par back, barring default. A tip: screen for exchange-traded debt, or check resources like Quantum Online that list preferreds and baby bonds. You might find, for instance, an AT&T 5.35% note due 2066 trading around $25, which is essentially AT&T debt you can buy like a stock. Just be mindful of liquidity. Some trade lightly, use limit orders, and the credit of the issuer. Stick with reputable ones unless you can stomach high-yield risk. 3. Business development companies, BDCs, high yields from private loans. Business development companies are a special type of closed-end investment firm that lends to small and mid-sized businesses. They were created by law to encourage funding to smaller companies. BDCs often yield 8–10% or more, making them very high income. They must pay out 90% of their taxable income as dividends, like REITs, which is why yields are so high. BDCs basically function like private debt funds. They loan money or take equity stakes in private companies and use the interest and gains to pay shareholders. The reason BDCs are hidden gems is that many investors either haven't heard of them or assume they're very risky. And yes, some are riskier. They deal with non-investment grade loans typically. But the industry has matured, and the top-tier BDCs have solid track records. For instance, Main Street Capital, Main, and Ares Capital, ARCC, are two of the largest and have long histories of paying and even raising dividends. RCC currently yields around 9 to 10% and has navigated multiple economic cycles well. BDCs benefit in a rising rate environment too, since many loans are floating rate, meaning their income can increase when interest rates go up. As we've seen recently, many BDCs have hiked dividends in 2022-2023 because higher rates boosted their net interest income. The keys with BDCs: look for ones with low leverage, good credit underwriting, low loan default history, and management alignment. Insiders often own shares, etc. Because they pass through income, dividends are usually taxed as ordinary income, not qualified, unless they designate part as capital gains or ROC occasionally. So they might fit better in an IRA, or you just accept the tax for the high yield. BDCs can be volatile with the market. They trade like stocks and often drop in price in recessions as people fear defaults. But that can present opportunities too. For example, during downturns, good BDCs' prices often fall more than their actual book values deteriorate, offering contrarian buys. Holding a basket of a few BDCs or a BDC ETF like BISD can mitigate single company risk. 4. Closed-end funds, CEFs. Diversified strategies, high payouts. Closed-end funds are a bit more complex, but they are worth mentioning as hidden income tools. CEFs are like mutual funds that trade on exchanges, and many employ leverage to enhance yields. There are CEFs covering all sorts of asset classes: high-yield bonds, mortgage securities, utilities, MLPs, preferreds, etc. Many CEFs pay distributions monthly or quarterly and often yield between 6% and 10%. They can achieve this by either focusing on high-yield assets, using leverage, borrowed money, to juice returns, or employing strategies like option writing. Some CEFs do covered calls, similar to ETFs we discussed, but often more flexibly. For example, there are CEFs like UTF, Cohen and Steers Infrastructure Fund, which yields 7% investing in utility infrastructure stocks plus some leverage, or PTY, PMCO Corporate and Income, which yields 10% from a mix of bonds and heavy leverage and active management. CEFs often trade at a discount or premium to their net asset value, which is another wrinkle. You could snag $1 of assets for $0.90 if a fund is at a 10% discount, increasing your yield effectively. Why are they hidden? CEFs are not as widely known outside income investing circles. They aren't talked about on CNBC much. They require a bit of research to understand the nuances and the fact that market price and NAV diverge. But for an income seeker who does their homework, CEFs can offer diversified exposure with an enhanced yield. The caution: leverage amplifies losses too. So in bad times, CEF NAVs can drop sharply, and sometimes distributions get cut if income dries up. It's important to choose funds with good long-term management and to not overpay, i.e., be wary of buying at a huge premium. Many retirees use a bucket of CEFs to generate a consistent income stream that's much higher than a 100% unleveraged portfolio could give. It requires monitoring but can be quite effective. In practice, how might one use these hidden gems? Suppose you have an income portfolio mostly of blue-chip dividend stocks yielding 3% and some bonds at 4%. To boost overall yield, you could add, say, 15 to 20% allocation to preferred stocks via an ETF or a handful of issues. Yielding is 6%. That immediately bumps income a bit. You could also allocate a portion to a solid BDC or two, maybe 5–10% in total, capturing 9–10% yield there. If you're comfortable, maybe a 5% slice into a well-chosen CEF or baby bond fund for another 7–8% yield. The result is a more diversified set of income streams. Corporate profits via dividends, fixed income via preferreds, bonds, private loan interest via BDCs, etc. They don't all move in lockstep. In a low-rate environment, BDCs and some CEFs might shine. In a credit crisis, maybe your treasuries and some preferreds hold up while BDCs dip, giving you a chance to rebalance. The point is, these assets add breadth to your income strategy. Let's illustrate with preferreds specifically as a hidden gem. Many people who want income run to high-dividend common stocks, sometimes ending up with companies that have shaky fundamentals or high payout ratios. They might ignore that a bank-preferred stock paying 6.5% might actually be less risky than a random small-cap stock paying 6.5% dividend. The bank-preferred might be investment-grade rated and just subject to rate movements, whereas the small-cap stock's dividend could be cut if earnings slip. So including preferreds can actually increase stability of income while keeping it high. Over a long haul, preferreds historically have provided stock-like returns with lower volatility, largely from the rich dividends. They won't give you much capital appreciation. They're more for steady eddies. But that's fine if income is your goal. As always, before investing in these, do your due diligence. Preferreds. Check if they're cumulative, check if they have a call date. Many can be called at $25 after a certain date, which just means you might get paid off at par. BDCs, examine their portfolio quality and dividend history. CEFs, understand the strategy and look at how consistently they've paid. Some have managed stable payouts for decades, others fluctuate. To conclude, the world of income investing is much broader than just common stocks and regular bonds. By venturing a bit into these lesser-known areas, preferred stocks, baby bonds, BDCs, and CEFs, you can potentially find a sweet spot of high yield and reasonable risk. They are the hidden gems that, once you discover, you might wonder why you hadn't included them earlier. They're not for 100% of your portfolio, but a slice in these can spice up your income without blowing up your risk if done prudently. Diversification is key. Each of these asset types has its own risk factors, so mixing them can actually create a robust overall income stream. And remember, hidden doesn't mean unsafe. Often it just means underutilized. Many institutional investors and savvy individuals quietly use these tools all the time. Now you're in on the secret too. So explore these gems further. Consider how they might fit your needs, and you could be on your way to a stronger, more diversified income portfolio, enjoying those steady yields that others might be missing out on.